It's been an interesting start to the year as far as the dollar is concerned. Trading very low over the course now of the last 6 or 9 months, and it started to see a little bit of support. Now, there's a couple of reasons why that may be. This really started with those Georgia runoff elections. Since the Democrats secured a double victory there, giving them effective control of the Senate, we've started to see a rise in US yields, particularly on the longer end, really indicative of the fact that the market is now starting to price in much more fiscal stimulus in the near term, which may generate some inflation and force the Fed to consider tightening monetary policy earlier than was previously expected. And this seems to have given some belated support to the US dollar, which, as I say, was extremely oversold going into this. So maybe we are just seeing also an example of a bit of a short squeeze. You look at the dollar across a lot of different currency pairs, and you were seeing that we were starting to see divergences forming. So maybe these rising yields has provided the opportunity for a little bit of a profit taking, a minor correction that had been coming anyway. But US yields have continued to rise. The last 24 hours or so, we've seen them pull back a little bit, but we have seen it rise considerably, going through 1% on the 10-year and continuing to climb another 15 basis points or so. As far as the euro dollar is concerned, we peaked around 123.50, but we've pulled back towards around 121 at this point. We're seeing some near-term support. Obviously, the key level here is going to be that 120 mark. This is where we've got longer-term support and resistance. This is where we have the rising channel coming into play as well. I think a break of this could be the catalyst, or at least could indicate that we're going to see a much more significant correction as far as the US dollar is concerned, potentially even opening up and move into this into a new trending channel between around 116 and 120 maybe, as we've seen previously. So these are the levels which I think we'll be keeping a very close eye on in the near term. As long as US yields continue to rise, I do think we will see continue to see support for the US dollar at what is still considered to be extremely low levels. Now, the Fed is going to have a strong word in this, obviously. There's a lot of Fed speak this week, and already the speak that we've had from the Fed has really focused on two things. One has been the optimism around the outlook for the economy, not taking into consideration the prospect of more stimulus. The comments suggesting that the economy has been more resilient and the expectation of a strong bounce back later on this year. That has been one theme from what we've heard this week. The other being a number of warnings that there's no prospect of tightening in the near term, that the conversations effectively won't even be starting anytime soon. So they really want to reaffirm their dovish stance, and that may be why we've seen US yields pull back a little bit over the course of the last 24 hours. But there's still a lot more Fed speak to come, and I think it's going to be increasingly important now over the coming weeks and months, as traders start to look for signs that more fiscal stimulus, more inflation could prompt the Fed into acting a little bit sooner. But for now, we are seeing US dollar support, and a breakthrough 121, 120 could potentially indicate that the market is moving into more of a corrective mode as far as the greenback is concerned. Should these levels hold, then 123.50 becomes the level to keep a close eye out for. But in that circumstance, I would keep a very close eye on those momentum indicators. That's where the warning signs came when we were reaching that level more recently, that this was starting to look a little bit exhausted.